Key levels are specific price points on charts that are significant to the market's psyche. They are zones in asset pricing that have a historical importance. Now, key levels are critical to traders because they help us locate where to buy and sell the market, as well as to understand the market's actual state. In this video, we'll show you how to maximize the functionality of key levels. Key levels aren't just random numbers. They are price points that have been tested and respected multiple times. Now, a key level is historically significant. It represents the market's collective memory. It's important to remember that a key level doesn't have to be a singular price point. It can also be a small array of price points. All right, more on that a bit later on. Functionally, a key level can act as support or resistance. In the case of support, prices bounce due to high demand. In the case of resistance, prices fallen due to high supply. That's why many traders equate support to demand and resistance to supply. So why are key levels so important? Think of them as a roadmap to the market, one that illustrates herd behavior. Key levels signal where thousands of stop loss, profit target, and market entry orders may reside. Armed with this information, we can confirm areas of support or resistance, as well as establish a bullish or bearish market bias. Key levels come in all shapes and sizes. Here are 3 ways to identify them on your pricing chart. First one's big round numbers. I'm a big fan of big round numbers. As you can see, they're just areas of natural support and resistance. $75, $75.50, $76, $76.50. A great example for WTI crude. Notice how price sort of consolidates around those zones. That's why they're called areas of natural support and resistance. So be aware of big round numbers. The second is channels and trend lines. A trend line really is connecting any two swing lows or swing highs. Swing lows are going to be support. When you connect swing highs, those are going to be resistance. For instance, we have sort of a bullish uptrend here. We're connecting our swing lows. There's our key level right there that's going to act as downside support. All a channel is 2 trend lines. You're going to connect the bottom and the top and sort of find a range where price is trading within. You've got resistance to the top side as your key level, support to the downside as your key level. Lastly, very important, the previous day, week, or month highs and lows, something that a lot of traders don't recognize. These are very, very important levels. So we're just going to go with our previous month's high, our previous month's low, our weekly low, our weekly high, our daily high, and our daily low. And by identifying these levels, we can see where price action has clustered in the past, and that's going to give our key levels a memory and an opportunity for us to identify support and resistance. More importantly, locate where stop loss orders and profit target orders and market entry orders may be. So those are 3 ways that you can identify key levels: big round numbers, channels and trend lines, and also the previous day, week, or month high and low. The first type of key level trading strategy that we're going to execute is a breakout. Now, you remember our trend lines from earlier. We use those to identify key levels. Well, this is going to be a trend line breakout trade. Now, it's got 4 steps to it. Listen up. The first one we have to do is define the trend. That's relatively self-explanatory. We've got a US 100 5-minute chart and then a nice uptrend here. The second thing is to locate our support and resistance levels. In this case, it's going to be a support zone because our key level is going to be our trend line. The third thing we have to do is identify our tests. Now, trend lines are great because the tests are baked into the cake. Really, all we're looking for is to connect at least 2 price points, and that's going to build our trend line. Well, those could be considered tests. And then lastly, we're either going to sell below support or buy above resistance. Why? Because we want to get in on that momentum. Once our key level gives way and those bidders aren't protecting the downside and the sellers aren't protecting the upside, we want to get in on that momentum or that washout in price action. So let's go ahead and roll forward in time here using our TradingView replay functionality, and you'll see we're just sort of creeping up. Our uptrend is still very much in play. What are we looking for right now? We're looking for another test of our trend line, and then we're going to look to sell beneath our trend line. Okay, right there. We got a pretty good test of our trend line and a bit of a bounce. So from here, we're just designing our trade, and that's just a function of, where we want to get in and where we want to get out at. Something like this. Stop loss, a good rule of thumb, is just above the previous swing high, no matter what time frame you're on. Shorter time frames are going to be cheaper trades, but this is a pretty good stop loss location. And then my profit target. What do I want to do? What kind of risk versus reward ratio do I want to put in? For me, let's just go ahead and put just a basic 1-to-1. I'm a 1-to-1 type of a trader, maybe just a shade over 1-to-1 to cover commissions. That's the type of trading I favor. And all we're looking to do is we're going to sell once price breaks beneath our trend line, and we're going to see if we can hit our target. So let's go ahead and roll forward in time, and you'll see right there's our test, there's our break. Now, can we get this thing to our profit target or can't we? You'll see right there sort of breaks down and fills us up, gives us a good chance really at making our profit target, and there's our break. So as you can see, not too bad of a way to trade. Once that key level went, we got in on that bearish momentum, went down, got paid off, had a real nice risk versus reward on this one. So a solid trade. That's a breakout trade beneath the key level. In this case, we used a trend line. All right, let's try another way to trade key levels. All right, the second way that we're going to trade key levels is we're going to use them as support and resistance zones, and we're going to try to predict short-term reversals and price action. Now, there's 3 basic steps to executing this strategy. Number 1, we're going to identify our support and resistance levels. Number 2, we're going to establish confirmation. And number 3, we're going to enter the market. So here, you remember our big round numbers from earlier. This is a WTI 5-minute chart, really very active, especially when we're going to be looking at this right now. So we're going to begin our trading day right around that U.S. cash open, about 9:30 a.m. Eastern, a highly active time for WTI crude. And what we're going to look to do is we're going to look for tests of these key levels, these big round numbers from earlier. We're going to look for tests of those and then confirmation. Now, confirmation can be anything you want it to be. You could use a momentum oscillator like an RSI or stochastics to tell you if the market's overbought or oversold. You could also use chart patterns, something like a doji, something like a morning star or evening star. You could use those to get you into the market. For us, we're going to use chart patterns. I'm going to focus on, number 1, a doji, and then potentially any other chart pattern that's obvious to me. Engulfing candles are great for this. They really are. And then the other thing is hammers. I'm a big fan of hammers. A nice big hammer candlestick is a reversal pattern. If you see a hammer around a key number, you got a pretty good chance of getting at least a short-term reversal. All right, let's go ahead and roll forward in time on our trading view market replay functionality. And you'll see right there, we got a great test of 75.50, but we didn't really get any confirmation up there. So that would have been a tough trade to take. I will tell you, you can take these naked, but that's a sort of a different animal because you really don't have a stop loss area. So now we've got a test of 76 up there, and I'm interested. I'm very interested. 76, a big round number, nice key level. And what do we have? We have a nice big break on the open, and now we're rotating, and there's my doji. There's my doji. So what do I want to do? Well, we've got sort of a rotation up here right around 76.17 or so, and I'm looking maybe to sell beneath that doji. Maybe I want to sell beneath 76, our key level. This area, remember, these things don't always act exact. You're going to have to give them a little bit of leeway, and if your confirmation's in the neighborhood of your key level, you sort of have to treat it like price is becoming exhausted, and that area is holding up nicely. It's at least drawn some sellers, and that may exhaust the bidders in this case. So what do I want to do now? Well, what I need to do is I need to build a short trade. How would I do that? Well, let's go ahead. Let's go right there to 75.99. Let's bring our stop loss. A pretty good rule of thumb is going to be right maybe above our confirmation on a short or below it on a long. And then once again, we're just building risk versus reward trades. I'm a big fan of 1-to-1s. Let's go ahead and shoot for the moon here. Let's go ahead and see if we can get a 1.5-to-1 trade to come home. That really knocks our winning percentage way down. Now think about what we're doing. We've got our key level. That area is drawn heavy two-way action. In this case, it's acting as resistance. I want to get in on that retracement in price, even if it's for a very short time. Okay, let's go ahead and roll forward in time and see how this trade goes. There's your pullback. There's your break right there. That's a pretty solid break, but then we go up and we take out the top of our doji. So that is a tough pill to swallow. That right there would have been a loss at 1.5-to-1, but you can see we got some real nice price action there. So maybe if we were just shooting for, I don't know, a 1-to-1 ratio, we would have cashed in nicely. So that's a good example of how you use big round numbers to trade reversals. Remember, very easy to do. Identify your support and resistance level, establish confirmation with any tool you'd like. Just be consistent with it. Do a little back testing. See which tools really make sense to execute these trades with. And then lastly, enter the market. When we enter the market, we always do it. Stops down, profit target lined up, and we're just looking to make positive expectation trades over time. That's how you make money. So those are two basic ways to trade key levels. That's really about all there is to it. Key levels are powerful tools for traders. They help us understand the market psychology and fine-tune our trade locations. However, they aren't the ticket to riches. Now, to consistently make money with key levels, you must incorporate them into a comprehensive trading plan, one that clearly defines risk management, trade selection, and discipline. Now, if you can do that, then key levels are a great way to approach the markets. I want to thank you for watching this video. If you liked it, give us a like. If you want more content like this, go ahead and subscribe to our channel. If you have any questions or comments, be sure to leave them below. All right, that's it for now. Trade the action well, and we'll see you in the markets.